Real estate stocks are crashing with the rest of the market, and the index is down 30% since January. So why aren't these assets protecting investors from panic, and how do you find the REITs that will help grow your portfolio? In this video, I'll show you the outlook for each of 10 property types and then reveal the 3 best REITs to buy right now. We're talking real estate stocks today on Let's Talk Money. Beat debt, make money, make your money work for you. Creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now Nation, you know I'm a big believer in real estate, not only for those double-digit returns and that cash flow, but also as a way to smooth out the ups and downs of the stock market. No other asset class has made as many millionaires, as much legacy wealth as property, and it can be a huge stress reliever when stocks crash. Of course, that's how it's supposed to work. Real estate is supposed to save your assets when other investments crumble. So what the hell is happening right now? The Vanguard Real Estate ETF, ticker VNQ, a fund of almost 300 real estate companies, has plunged 30% so far this year, far worse than even the 23% loss on the S&P 500. But you see, that broader real estate number is misleading because of the giant difference in returns on different property types. In fact, I found a few REITs that are actually positive on the year. In this video, I'll walk you through the data to find the best real estate stocks and which ones you need to avoid like the plague there. A little too soon? Here I put together returns data on a real estate investment trust with a market cap over $50 million. That's 209 REITs tracked by Morningstar, and you really start to see the winners and the losers when you look at it this way. There are just 8 REITs with returns in positive territory through March, and the first thing you want to notice here is the trend in property types. So in this first group, you're seeing data centers with Digital Realty and Equinix. You see government properties in that Easterly and the Postal Realty in the next group, and then you've got a few cell tower REITs as well. Back to the data though, and another 9 real estate stocks are showing losses of less than 10% year to date, which sucks, but it's still a hell of a lot better than that 20% plus loss on the market. Our next group here is 16 REITs that are posting losses of between 10 to 20% this year, and here we're seeing some of those farmland REITs as well as the storage stocks. Now bear with me here because it's about to get ugly. I want to take one more look at the chart and then I'll go through the outlook for each of these property types as well as revealing those 3 best REITs to buy and the ones to avoid. Another 27 REITs suffered losses from 20 to 30% in that January through March period. And the trend in these seem to be the healthcare, residential, and industrial stocks. And while you would think healthcare would be doing well right now, those senior care facilities have been hit hard, and hospitals are trying to figure out how to deal with surge capacity. Last year, and this shouldn't surprise anyone, those real estate stocks in hotel, office, and retail have been slammed with losses over 30 to 50% and worse. Now, before I reveal my 3 favorite REITs to buy, I want to walk through an outlook on these 10 real estate property types. Please watch through these because I get a lot of questions about these in the Facebook group, especially on those mortgage REITs that are posting dividend yields of 10% and higher, but could be about to crash. First, we have 3 property types that I think could do fairly well over the next year, those digitally focused storage and industrial REITs. So here we're talking about those REITs holding data center property, fiber optic, and those connectivity assets, and the cell towers. These companies could actually benefit from that stay-at-home environment. Now, even after we get back to business as usual, we're still looking at an explosion in data from 5G and the Internet of Things appliances. So any property that helps that flow of data, whether it's from your phone or your computers or other devices, it's going to all be big winners. Now understand, I'll be showing you examples of these REITs in each of these property types, but that doesn't mean to rush out and throw all your money into these. I'll share my 3 top picks in a moment, but make sure you check these things out for things like the growth in funds from operations, that FFO measure, price to FFO, and then the coverage ratio of the dividend over the FFO. Industrial REITs, especially those that own the warehousing space and the logistical assets, could do really well also. Another trend of that stay-at-home economy is the online shopping, and all those deliveries have to be stored somewhere before they get shipped out. That means demand for warehouse space could boom in the future. Storage REITs could also do relatively well. We're a consumer nation. People just buy way too much shit that they then need to store away. Now this one is probably a little shakier than those other 2 types, especially if the unemployment rate gets so high, so bad that people stop paying for their storage units. So far though, we're seeing pretty good performance from those storage REITs. Next, we have 3 property types that are more of a question mark, so probably require a lot more research to make sure that the companies are well positioned. These include healthcare, residential, and farmland REITs. Now, healthcare REITs are really the biggest question mark here and could either do really well or just crash into bankruptcy. Obviously those senior care facilities are hurting and could see a demand crisis depending on how bad this epidemic gets. You would think, though, that those hospital and the healthcare facilities would do really well considering the caseload, but understand that a lot of those treatments might not get fully reimbursed or just fully paid back. We don't know what kind of lawsuits are also going to come out of this. Hospitals not being able to meet that surge demand or other problems. Now, there is probably a distinction that needs to be made here between the real estate stocks that I recommend during this crisis and the ones that could be your best returns afterwards. We could see a wave of healthcare spending to upgrade infrastructure and then capacity. So once we come down from this peak of this emergency, the hospitals and those other healthcare REITs could be some of your best bets. There's also going to be an opportunity in those hardest hit real estate stocks that we'll look at, including those senior care facilities. Now, I'm not saying jump in right now because I don't think the worst is over. There was going to be a lot of those hotel, retail, and office REITs that will not make it. But just like the banks after that 2009 financial crash, picking up the pieces after this disaster could be some great returns, but I think you can wait it out as much as a year to make sure that the REITs that you're investing in these property types will survive. Residential REITs, so those owning apartment buildings and single family homes, these are really another question mark here because it should be relatively counter-cyclical. Now that means the demand for the properties doesn't follow the economy down as much as office or retail space in a recession. The problem here, though, is those mortgages and the rent deferral programs passed locally and federally. Now, this might be a great program to help people in need, but the buck's got to stop somewhere, and it's going to be investors that eat it. Now, larger apartment REITs are probably going to be better able to manage this. I'm not sure about the REITs that owning single-family properties, and the losses are going to be astronomical in that student housing REITs. As an Iowa boy, farmland REITs are something I've been watching for a while, but you might want to hold off investing in these. Obviously we still need food, so the demand is there for the land, but farmers were already hit on that trade war with crop prices hitting multi-year lows. Now with the virus, it's not going to help those farmland defaults. A lot of the larger farms are reporting difficulty getting the people to help with their crops, so that migrant labor they used to count on is just not there anymore. Now the real estate stocks that are going to be hardest hit with this crisis, and again, there might be an opportunity to pick up the pieces sometime in the future, but we're going to see massive losses on these, and many of these hotel, office, and retail space may never rebound. So understand that it's not just the virus that's been hitting these office and retail property spaces. We've seen that trend in telecommute and work from home, as well as the growth in e-commerce developing for years. The problem for many of these REITs is that not only does that shelter in place threaten that rents go to zero for a period, but it also accelerates that trend going forward. I think we're going to see a lot of companies keeping a portion of their workers on contract on that work from home basis once they see how much cheaper this is. We'll see more people shopping online after they're forced to do it and realize how easy it is. And that's going to be a problem even for these quality office and retail REITs. Even marginally lower demand for this space is going to bring down rents across the board. So even that Class A office space is going to get hit. So maybe the best of the bad here is those hotel REITs because they should see demand rebound pretty close to normal after people start traveling again. For now, though, conferences are being canceled and people are calling off their summer vacation plans, so it's going to stay ugly for a long time. Now, there is a caveat with office space, and it's in those REITs operating government property, which is generally more stable anyway. That $2 trillion in stimulus is going to mean more government workers to manage it. So these REITs could be relatively safe. Now, I have to talk about one of the most popular REITs out there, Realty Income, ticker O. Now, more than 85% of the property in this portfolio is retail focused, so right in that danger zone. Now, most of Realty Income property is in that non-cyclical type like pharmacies, convenience stores, and dollar stores, so it might not get hit quite as hard as some of those other REITs owning the shopping malls. But again, though, just as a generally weaker consumer spending environment is going to hit the company, so be careful here. Our last property type here before those three best REITs to invest in, and this one isn't an equity REIT. I'm talking about mortgage REITs or MREITs here, and these could be the next big crash in the market. I gotta tell you, investors are going to be the ones eating all those rent deferral programs and the prohibition on evictions. Not only that, but new issues in mortgages, so the investment supply for these companies could be a huge problem. I've talked recently to some mortgage broker friends that are pointing to problems with the non-qualified portion of the mortgage market. Those loans that don't qualify for federal guarantee programs, and that defaults in these could surge higher. So that's the outlook on these property types, and I think a few of these could really come through, not only in that ability to protect your portfolio from more of that stock market pain, but the returns here could be very strong. Now I want to reveal those 3 best real estate stocks, 3 REITs I'm buying, and the ones that deserve another look. First here is Digital Realty, ticker DLR, and you could probably look at Equinix, ticker EQIX, in the same theme. Digital Realty owns 260 data centers in 40 major cities all around the world, so you've got that data theme plus some international diversification. Your shares are up 12% so far this year, and not exactly a steal at a price of 20 times funds from operations. The stock does pay a 3.3% dividend yield though, and should be a great consistent grower for your portfolio. The standout in an otherwise tough office market is Easterly Government Properties, ticker DEA, with a 4% dividend yield. Now the company owns 68 properties across the US and leases to government agencies, so you've got more stable demand here compared to that traditional office space. Their shares are up 5.7% in 2020 and also trade for that 20 times FFO. Next is a play on that 5G theme with American Tower, ticker AMT, owner of 180,000 cell towers on nearly every continent. Now, even though AMT is down 4.8% this year, I think I like it a little better than rival SBA Communications, which is actually up 10% year to date. The dividend yield of 1.8% is higher on AMT, and it trades for 25 times FFO versus a much higher 35 times valuation on shares of SBAC. AMT has a much broader base of towers across North and South America, Asia, Europe, and the Middle East versus just 30,000 towers in SBAC, and mostly in the US and Brazil. Still though, both might do well on that 5G rollout and the trend in that Internet of Things idea. Now for the 3 REITs to avoid, I'm going to go back to those broader property types and not recommend against a specific stock, just so I keep my ass out of court. And we're talking here about the hotel, retail, and mortgage REITs. So for the hotel group, how long is it before people are really comfortable with traveling, and what happens if there's another outbreak in the fall? The flu comes back each year, and there's no evidence that coronavirus isn't going to be just as seasonal. For retail-focused REITs, especially the ones owning shopping malls and large department store space, we've already seen that multi-year disaster in these. Companies like Sears and Toys R Us fell into bankruptcy, and even the stronger names like Macy's, they're on the edge, and that's when consumer spending was strong. What happens when retail sales fall off a cliff and never really rebound into that traditional space? Retailers are completely shut down, and some, like the Cheesecake Factory, have publicly said they're not going to be paying rent right now. The trend to online shopping is only going to accelerate in all of this, and there could be a wave of retail vacancy over the next year. As for those mortgage REITs, nation, please do not chase those yields. I know double-digit dividend yields look like they're going to make you rich, but these companies are going to be the ones left holding the bag when people just can't or won't pay rent. Now again, you've got a choice to make for these real estate stocks. You can go with these 3 REITs that are going to be relatively safer and still provide those solid returns, or you could try to catch that falling knife in these hardest hit properties. Now the hotel, the retail REITs, they're trading at huge discounts, and some will survive to rebound after this crisis. Don't feel like you need to rush into these though, and instead wait for the dust to settle on those bankruptcies. Want to start building your real estate empire? Click on the video to the right for 7 ways to invest in real estate with no money down. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.